And this is my daughter, Jamie. Hi, how are you doing? And now you want to tell us how old you are?
4 years old.
Okay. And not how much money you make, it's how you spend it. So many people come to me and they have problems, and they can be making $20,000 a year and have a budget problem, or they can be making $100,000 a year and they still have budget problems.
Find time to sit down with your spouse, and even with the whole family, kids could learn from a budget also, seeing where the money goes and what's coming in and what has to be paid for. They can learn from something like that.
That's really important is that you need to pray about your budget.
Well, I think it's very, very good when you sit down to discuss it, to pray about it and help God, have God help you see what you need to work on and help you to keep your tempers when you're doing it.
Tell us, what's this jar here for?
College.
Okay, this one's for college. And then we have 20 cents here. Where does this dollar go? Okay, you want to put that money in there? Okay. Those 25 years, it's funny to see myself and then Jamie. We found those videos, and so we thought we'd share them with folks. So, yeah, so Jamie started in the financial business a long time ago when she was 4 years old. So anyway, so thanks for watching that, and so I'm going to continue on here. Okay, so we're starting our seminar here. We have disclosures, whatever we say, you need to talk to your accountant, your attorney, whatever. It's just general advice. It's not specific advice. We have 4 people here today speaking. Me, Nathan we're introducing Nathan in our speaking team. Topics, Daniel's going to be speaking on what's going on, and Jamie's going to finish us off here. Survey notes at your table. You have notes. Please write them down when you find something, because when you go home with a belly full of lasagna, you'll forget what happened after your nap. And so write it down so you can remember. And then the survey, please fill it out. If you want to have us follow up with things, then please let us know, and we'll continue on with that. Okay, my talk is kind of the fun, easy part. We've been in this building. We bought this the month before 9/11, and We bought it, closed on it, and then 9/11 happened. I thought, what did I just do? We moved to Montrose, and we've grown in it. It was just Janet and I. Then we hired Gina and so on, and we kept growing. We had Adam in there and several other people, and now we have 7 people in our office. And so we are very crammed. And so, issues that we have now is parking. We're parking down the street, just so you folks don't have to walk a half a mile to get to the office. Stairs, handicaps, the heating or the cooling system is really a problem we're having. One restroom, it's not handicap accessible. It's old technology. It's just a tired old 1954 house that we need to change. So, new announcement, here it is. Oops. There it is. This is our new office. And so it's 2 stories. We will rent out the 2nd floor to a quality company. We have a lender looking and a couple other possibilities. We'll be on the 1st floor here and sharing that also with Carol Viner, the attorney next door. She'll be coming over with us too. So we have a lot more space and larger conference rooms, better heating and air conditioning, just new technology. We're getting a whole new network internet system in so we can operate and be more efficient. We're going to have a lot of other features, safekeeping boxes instead of like a bank has safety deposit boxes. This is just a safekeeping box. If you want a key, you can have one and use one of those. Just a lot of nice features. 2 bathrooms, plenty of room for that. Break room, so we're not just sitting at our desk and eating lunch. So that's our new office. Going to look like that, and it's going to be right next door. If you drive by our office, if you don't already know, there's that big green fence and that big lot. We tore that building down this summer, and we're going to break ground. It's supposed to be next week. The city's supposed to be doing a walkthrough tomorrow, and we'll see how that goes, but everything's all lined up. So this building will be facing our old building. We'll be selling this building, and we own this other building over here. We'll be selling that one too to simplify my life so I don't have so many properties in my life. So that's the new excitement for us. So you'll see us breaking ground and changes, and hopefully you'll like it. It's Jamie and I and the team have been working together on just designing this office from the ground up so it can be very efficient, and it can last the next 30 years. That old house is just barely keeping us going the way it is right now. Jim, do you have a projected Oh, 5 years from now? We don't know. I mean, I'm hoping for summer of next year. We'll see. Everything takes longer. It took longer. It took us a month and a half to get the asbestos out. So it's just, you always run into problems, and the city has gotten, as it's gotten bigger, it's gotten more bureaucratic. Okay, we won all kinds of awards. You saw that in that video there. So that's pretty cool. Next we have is Nathan. So Nathan's going to give us some information on what's going on. So let's welcome Nathan.
All right, hi everyone. I see a lot of familiar faces. I've met, well, it seems like the majority of you, but for those of you who I haven't gotten to meet yet, like you said, I'm Nathan Maness. So I joined the team as an advisor earlier this year, and working on my CFP. Prior to that, I was with Northwestern Mutual, so kind of got some more experience on the insurance side of things, and then some exposure to the investments, and kind of knew of the Elder family from way back when my wife and Jim's youngest daughter, Jessica, went to school together. So enough about me. We're going to talk about the merger and some other hot topics. So for those of you who had any issues with the merger, I'm sorry and thank you. For 99% of you, it was smooth, no issues. We got you all set up, or you did it all on your own. We've had some good feedback, but I want to acknowledge there were a couple glitches for a few people, so thanks for bearing with us then. So there are a couple of things to be aware of as far as just kind of thinking ahead and not getting stuck behind the 8 ball. So some trades can take a day longer than before. Now, not all, like money market is still one day and quick, but just remember, these funds have to settle and then get transferred to your bank account. So just think a little bit ahead. If you need the money tomorrow, you're kind of too late. Also, there is a process where we have to link new bank accounts a little differently, and there has to be some verification. So if you get a new bank account or you anticipate needing to transfer to a new bank account, don't expect that to happen same day. They say it can take 2 weeks. It hasn't taken that long, but basically we don't want to get stuck in a position where your banker is asleep at his desk and he doesn't process it fast enough and he's holding it up. So there's a lot of... Give me your phone. Causing feedback? Yeah. Sorry, phone's causing feedback, I guess. So there's a lot of benefits to it. All in all, there's much more positives than negatives, and we're happy with it. So got access to lower fees, which is always great, right? If we can get same performance, lower fees, everyone wins. And then there's a lot more control on your end, especially if you're willing to do some things electronically. Number one thing I want to stress, don't go through this alone. If you have issues with anything or you just don't feel like logging on the computer and doing it yourself, give us a call, come in. Please do not get to this point before you call us. So, and I also want to mention, on your surveys, if you have any feedback, if there's been anything you don't like about the system or Schwab or any of that, please write it down. So Daniel and I are going to a Schwab conference next week, and we're going to be discussing some of that feedback with them. So, now we got some feedback going here. Do I need to go to the other side? Will this help? Okay. Everyone hear me okay? Good. So, yeah, anything you write down there, we're going to take a look at that before we head over. We'll be sure to, yell at them when we get there, discuss ways to fix it, and see what changes they have planned for upcoming. Going to be talking over a lot of other hot topics. AI has been a huge one lately, so I wanted to kind of address that here. That's been the huge thing in the news, and everyone's either really excited or freaking out, or many people are just like, what the heck is it? So just think of it as computers being trained to perform human-like tasks, okay? Most of you are probably already using it in some way. If you used your phone to GPS navigate you here today, you used AI. My washer and dryer at home uses AI to suggest what cycle I should run based on the time of day and what I normally run at that time of day. So just keep in mind, this isn't a brand new thing. It's just been gaining a lot of steam. So, whoa, I went too fast. So in your portfolio, a lot of you already have some exposure to AI stocks or companies. So chip makers are big in the AI world right now. You look at, like I mentioned, if you use your phone, say you use iPhone and you use Siri, Apple is an AI stock in some way. And so all these companies are integrating it. And we expect that in the markets, it's going to make things a little faster. Things are going to move quicker. We got to be on it. But also companies are going to have to integrate this technology. Or if they don't integrate it well, they'll kind of fade into irrelevance over time. So there could be some major changes, and some companies we've seen do well, maybe don't do a great job of integrating it and so on. But we just expect kind of rapid change. And Daniel and I are excited to learn more about what Schwab is seeing on this topic. So another hot topic, central bank digital currencies. I'm sure a lot of you have already heard of that. I hear some groans going on here. So essentially, think of it as a digital dollar, okay? Digital currency that you can transact, pull out your phone, send money to someone else, and eventually just cash isn't a thing anymore. We are so far from that being reality. But the Federal Reserve did roll out FedNow, and basically that's a program that allows banks and individuals to transact money quickly. So I view it kind of as they're laying the road base for a central bank digital currency. There are some benefits to it. Like I said, someone sends you money, you have access to it instantly. You don't have to wait for the bank to process it. It happens instantly. And you can, if you run a business or whatever, and, or you want to look back, hey, how much did I pay so-and-so for that thing 3 years ago? You can look back on it. And then obviously using that to deter crime, making it harder to transact money without it being, seen. There could be some benefits from that, but obviously there's some major concerns about privacy and the power we would be giving to the federal government. Obviously, I don't think I have to beat that point, to a pulp. Most of you get that. But I do kind of view CBDCs as a Trojan horse, I view FedNow as a Trojan horse to CBDCs. So the good news, though, is that there are people pushing back. So most people do not want it. Most people are putting pressure on politicians, and they can't just shove this down our throats and cause big panic. Because what do politicians want? They want to be reelected, right? This would be political suicide for them to just shove it down your throats. So I view it more as a slow thing that's not going to have a big effect in the near term. But it's also encouraging to see other countries are fighting back. Some that have, strong dictatorship are trying to put pilot programs in place and force this. But in a lot of countries, people are fighting back. But yeah, this will continue to be a topic in the future. But now let's jump to what's been going on in the markets. So if you were at the last seminar, you heard Jamie talk about what happens in January is usually a pretty good indicator of how the year is going to go. And if you paid attention to the markets those next couple of months, you would have thought she was crazy because things got a little wild and we dropped, we dropped 7.8%. And there was a lot of fear during that time. But if you held on, just like if you look at past history, when you have these big downturns, you tend to get rewarded when you hang on through them. You look back at 2020, down 34% almost. The year ended up over 18%. This year, this is a few days old, so it's 11.5. We're up closer to 14% now. So looking at the S&P 500, what was that big scare? Bank failures, right? How many of you remember that? People were freaking out. You probably haven't thought of that in a few months now, right? And then there was the debt ceiling negotiations and what's going to happen, and oh my goodness, everything's going to fall apart. Well, then that all got settled. Markets got really optimistic, started to tick up. Now, in the past couple of months, there's been some fear over potential recession, and that's caused the markets to kind of soften a little bit. We kind of expected it. September and October tend to be pretty volatile months, and it stayed true to that this year. Now, most of you don't have, well, none of you have all of your money in the S&P 500, right? So looking at the bond market, last year got hammered down almost 18% on the 10-year Treasury. This year, still down 3%, which isn't good, right? But a heck of a lot better than last year. So when you look at this, one way we like to look at portfolios for more of a moderate conservative type, we'd be looking at 60% S&P 500 and 40% bonds. When you look at that, performance year to date is around 6.7%. Money markets and CDs have been awesome for a lot of folks this year. It's been a really great place with minimal risk, great liquidity, money in and out, a good place to put some cash while you're waiting to move it. Money markets are currently at 5.25%, and CDs are a little above that. But I'm going to go ahead and stop here, and I'm going to let Daniel tell the story behind the numbers.
Problem child. All right, can you guys hear me? Yeah. All right, first and foremost, I want to apologize. I am recovering from massive, nasty allergies. So if I sound a little off or I'm coughing a lot, sorry if I sound off. For those of us, or for those of you that are in the front section, I forgot to get ponchos. You guys are in the splash zone. All right, what am I talking about? My head is like off right now. Okay, bank failures. So we're not going to be talking about 2023 in review because obviously 2023 is not over yet. We're going to talk about 2023 so far, and so far there have been major things happening this year that have dictated the recent uptrend in the markets, and that's what I'm going to be breaking down for you guys. We're going to talk about the bank failures, we're going to talk about the debt ceiling, of course we got to talk about the Fed and the interest rates, and then what we're doing in portfolios. This is a picture of Dr. Nathan Perry. He is the chief economist at Colorado Mesa University. He is also one of the contributing members of Governor Polis's Economic Council. He covers the economics on the Western Slope. Every year in around December, he is the keynote speaker for the Montrose Economic Forum. Show of hands, how many of you guys went to that last December? I know some of you in here were there. Okay. So, December 7th of 2022, Nathan Perry, he's given his keynote speech. He's talking about the economy. He talks about what's happening here locally in Montrose. He talks about what's happening in the broader, larger macro economy. He talks about the interest rates. He talks about the inflation. So come Q&A, I walk up to the microphone and I ask Dr. Perry, hey, so realistically, how much can the Fed keep raising interest rates until something in our economy breaks? And the reason why I ask that question is because all the talking heads on CNBC and Fox Business, when will the Fed stop raising interest? No, that's not the right question. The right question is when something in our economy is going to come unglued because the Fed was raising rates. Not even 3 months later, this happens.
4 decades after its creation, Silicon Valley Bank was the 16th largest bank in the US. It took just a day and a half for it to fall apart.
This is the second biggest bank failure that's ever happened in the United States.
Once seen as a major tech banking player, SVB's stunning collapse spurred other bank closures, rattled global markets, and threatened the livelihoods of startups across the country. So, what went wrong?
Well, gee golly Whitakers, Batman, if I didn't know any better, I said something went gone broke. And ironically, it was the banks. Now, I'm going to explain what was going on during the bank failure. But before we get to that point, I have to explain, how do banks work anyway? There is a simple answer, and there is a more detailed answer. Here's the simple answer.
Worst break I ever had. They all owed me money.
Quiet, Porcupine. And speaking of money, how about the $20 you owe me?
Oh, yeah? Well, I only got 10, so here's 10, I owe you 10.
Thanks.
Hey, Mo, you owe me 20.
Well, here's 10, and I'll owe you 10.
You owe me 20.
Here's 10, I owe you 10.
Here's the 10 I owe you.
Here's the 10 I owe you.
Here's the 10 I owe you. Good, now we're all even.
Some of you in here are right now a little confused. Daniel, are you saying that our banking system is made up of a bunch of fake conflated money that inevitably perpetuates on itself, creating an impending debt spiral? Or are you saying that our banking system's ran by a bunch of stooges? The answer to that question is yes. So, let's pretend we have a bank. And let's pretend we have $10,000. We're going to go to the bank and we're going to deposit our $10,000. Now, what the bank's going to do is it's going to take, let's say for easy math, 10% of that $10,000, which is $1,000, and they're going to throw it in the vault. It's cash on hand, readily available. Well, the bank can't just sit there, twiddle their thumbs, and have the money do nothing and wait for you to come back and get it. They have to make money themselves. They got to keep the lights on. They got to pay the staff and all that. So what they do is they take the remaining $9,000 and they lend it out. Anything between auto loans, mortgages, they lend money to the government in the form of treasury bonds. So basically on these banks' balance sheets are things like mortgage-backed securities, collateralized debt obligations, fixed income products like treasury bonds. All you really need to remember and all you really need to know is that some of the money at the bank is liquid cash, but most of it is actually invested in things like bonds. And for the sake of the conversation, I'm just going to refer to this as just bonds for the sake of ease. Now, normally, what banks are supposed to do is that they take your money and they invest it in very short-term bonds, or what's also known as short duration. Duration is basically a bond's sensitivity to changes in interest rates over time. So the shorter the time period of the bond, the shorter the duration, the less risk and volatility that bond's going to have. The longer the duration, the longer the time frame, the more volatile those bonds are going to be. So normally, banks will have 1 month, 3 months, 6 months, 9 months, a year, maybe 2 years most on their balance sheets. And every month or so, they're having a bunch of bonds coming maturity. They're taking the interest. And in case you need money, well, hey, we just got this bond mature. Let's give back so-and-so their money. This is where we start to have problems. Since the great financial crisis in 2008, for over a decade, we've been sitting on artificially low interest rates for a very long time. And you guys remember, it was not even 3-4 years ago. Money markets, CDs, 3 months, 4 months, these bonds were not paying anything. They were not yielding enough for the banks to be profitable. So what did the banks do? They started buying 3-year, and 5-year, and 7-year treasuries. They were even buying 10 years. They were increasing their duration risk. What you might also hear is duration mismatch. If somebody walks to a bank and deposits their money and the money is being, invested in a 10-year treasury bond, you guys are not going to sit there and wait for 10 years to get your money back. You need to have access to that money sooner rather than later. So there's a mismatch between the short-term needs of their clients and the overall volatility risk of the bond portfolios at these banks. Now, ElderAdo Financial, understanding that interest rates were dog feces, for lack of a better term, weren't paying anything, we did our best to reduce the duration risk. We purposely, during this, even before all this chaos came ensuing, we kept the duration short. We did what we could to take the risk out of the bond market in your guys' portfolios, knowing that at some point inflation was going to come wreak havoc and the Fed was going to have to raise interest rates. Now, Jamie has shared this before last time. I'm going to, and I'm sure I've shared this too. I'm going to kind of beat a dead horse with a stick. When interest rates rise, so raise interest rates at the Now, in retrospect, what does this all mean? So let's go back. Check. Okay, cool. I hate this microphone. I feel like Bob Barker. The price is right. No. You all win a new car. No, I'm not Oprah. Okay. Where was I? Okay, so you had $1 billion at a bank. Let's just keep it simple. And let's say our bank has $100 million, so 10% in liquid cash, and the remaining is invested in bonds, and it totals up to $900 million, okay? When the Fed raised interest rates at the fastest pace in over 40 years as a knee-jerk reaction to the higher inflation numbers, that $900 million, and this is just a hypothetical, is now worth only, let's just say, $600 million. So you have $1 billion owed to clients, you have only $100 million in cash, and now your bond portfolio is worth $600 million. Uh-oh. And then people start to get nervous. And then word starts to spread. And people start rushing to the banks trying to get their money out before the last loser in line. According to the FDIC, all the banks in America, JP Morgan, Wells Fargo, anything from big mega banks, Bank of America to Alpine and Bank of Colorado, all together at one point were sitting on almost $700 billion in unrealized losses. Now, this isn't the total end of the story. Friday, March 10th, SVB implodes. News starts to break. Markets are falling. The regional bank stocks are absolutely getting slaughtered, right? You would expect that on a day like this. Later that evening, I get home from work. I get a text from a client because I am always working for all of you. I get a text from a client, and my client's like, Daniel, the bank failures. And I text him back, and I'm like, I know, isn't it great? Wait, hold on. What do you mean this is great? I'm like, I know, it's wonderful. And he goes, what are you talking about? What did I say at the very beginning? Something broke. The Fed had been very aggressive on its interest rate hikes, trying to bring down inflation. Now that something had broke, the Fed now was forced to take a more defensive posture, which means that brings the markets up. It means that they were having to intervene, which gives more confidence in the markets. So I text my client back. I tell him, all right, you don't need to freak out. We figured something like this was going to happen. And as far as the banks are concerned, I told him flat out, one of four things are going to happen. You're either going to see a bigger bank buy a smaller bank, the Fed's going to print money, or the government's going to bail them out, or some combination of the three. During this whole bank failure crisis earlier this year. Now, that was Friday. That was Friday evening. Sunday morning, the Treasury Secretary, Janet Yellen, goes on CBS's Face the Nation. And she said something, I'll just say, very interesting.
Your counterpart in the United Kingdom has said that the government there has ruled out a bailout of the UK arm of Silicon Valley Bank. Have you also ruled out that kind of government intervention?
Well, let me be clear that during the financial crisis, there were investors and owners of systemic large banks that were bailed out, and we're certainly not looking, and the reforms that have been put in place means that we're not going to do that again, but we are concerned about depositors and are focused on trying to meet their needs.
If you have not been a client with ElderAdo Financial for very long, or you have not spent a considerable amount of time with me, there's something about yours truly you should know. I can smell BS from a mile away. The reform and the regulation that she was talking about was the Dodd-Frank Act. It was signed by President Obama in 2010, where he said it would, and I quote, put a stop to taxpayer bailouts once and for all. Some of you are going to learn a very important lesson right now. When it comes to the law, when it comes to Congress, when it comes to finance, and especially when it comes to banking, loopholes is a gentleman's sport. Within the Dodd-Frank Act, there's a nifty little thing called the systemic risk exemption. What the systemic risk exemption basically says, that if a financial institution, a bank, that poses major systemic risk to the overall financial system, the chairman of the FDIC is then authorized to use taxpayer money to bail out the bank. Martin Grutenberg, who's the current chairman of the FDIC, testified in front of Congress shortly after SVB went down, and he said it was this exemption that he used $22.5 billion of taxpayer money to bail out SVB. Now, to be fair, SVB, I mean, this is Silicon Valley. This is like one of the world's investment hubs, so to speak. 26% of Roku's cash was at SVB. You can imagine what its stock price did when the news broke. According to the FDIC, 87% of all the deposits at the bank were not even insured. And again, this is Silicon Valley. Guys like Mark Cuban had $8 to $10 million at SVB. I find it interesting how a law that was designed to prevent banks from doing stupid stuff, taking on unnecessary risk, protecting the taxpayer, in of itself had a loophole that more or less incentivized banks to do stupid stuff, take on unnecessary risk, all while knowing that there was a lifeline. So, we got a government bailout. The other thing we saw shortly after Silicon Valley Bank was the Federal Reserve. They created what's called the Bank Term Funding Program, or BTFP, and they said, oh yeah, don't worry, it's temporary. So what is BTFP? So let's go back to our bank, and let's say a bank has a bond, and the face value of that bond is $1,000. Well, because the interest rates are high and bond prices are falling, now the market value of that bond is, let's just say, $600. So if you need to go get money from the bank and the bank doesn't have liquid cash, they are basically forced to sell that bond at a loss to generate what cash they can to meet your cash needs. So what the Fed did was they said, well, take that $600 bond, bring it to the BTFP, and we'll give you the full face value, and we'll inject that cash into the bank. Now, don't call me an expert or anything, but the Federal Reserve introducing new money into our financial system that otherwise would have been there looks like money printing to me. Yeah. Okay, so we got a government bailout. We got the Federal Reserve printing money. Oh yeah, one other thing. Sorry, forgot to mention. So what started off as an $11 billion program is now ballooned to a $121 billion program. And as our friend Milton Friedman once said, there is nothing more permanent than a temporary government program. Okay, so we got a government bailout. We got printing money. The only thing missing is now one bank buying another bank. That's not mine. I feel like I should be a ballerina dancing right now. It's so pretty. Like, okay, am I good, Drew? Okay. Where was I? Oh yeah, so one bank buying another bank.
We're back with some breaking news this morning. First Republic Bank has been taken over by federal regulators and sold to JP Chase. This comes after regulators spent the weekend trying to find a buyer for the bank.
Yeah, beginning today, 84 First Republic branches will reopen under JP Chase. This makes it now the third major bank to go under in less than 2 months. The First Republic closure has now become the second largest bank failure in U.S. history, surpassing Silicon Valley Bank.
So, I realize I should have printed bingo cards for everybody. Now, normally, okay, yeah, one bank bought another, so what? Well, there's always something more to it. This is, you can read this on your own on the U.S. Treasury Department's website. This is Section 622 of the Dodd-Frank Act. So much legalese that my congestion is not allowing me to read right now. So, basically what 622 of the Dodd-Frank Act basically says is that not one bank in America, not JP Morgan, not Wells Fargo, not Bank of Colorado, not Alpine, is allowed to have more than 10% of the deposit base here in America. When JP Morgan Chase bought First Republic Bank, they now own 16%. This is rule number 2 that you're going to learn today, or lesson number 2 you're going to learn today. Rules for thee. Not for me. The Federal Reserve, the Treasury Department, the FDIC facilitated an acquisition of a bank that in of itself broke the law. Go figure. Okay, so enough about the bank failures. The other hurdle we knew we had to deal with this year was the debt ceiling. Last time we were together in February, excuse me, last time we were together in February, we told you guys, we're going to have to deal with this debt ceiling thing. And we told you the markets might be volatile. And we told you that it was going to come down to the 11th hour, which it totally did. Now, there was something that I was not anticipating. The Republican-led Congress and the president sign into law the Fiscal Responsibility Act, which is the most fiscally irresponsible thing Congress has ever done in my whole entire life, and probably in all your lives too. Basically, what the Fiscal Responsibility Act did was, instead of like, okay, here's our debt ceiling of $31.4 trillion, we're going to raise it to X trillion dollars, 35 trillion, 40 trillion, and it's supposed to last us for Lord knows how long. Instead of doing that, what they did was they got rid of the debt ceiling altogether. Theoretically, we can go into infinite amounts of debt right now. If you ever wondered what a drunken sailor with a credit card with no limit on it looks like, this is it. Now, I thought a really long time about how I wanted to present this information. Okay, so we don't have any debt ceiling. What does that really mean? So I thought I would present it in a way in terms of our greatest commodity, which is time. Question: how much time do you think it took the United States government to go from $0 of national debt to $1 trillion? Give me a number. 5 years, 10 years, 20 years. 200 years, okay. Anyone else? No? Okay, no class participation. Took us 195 years, over 75% of our nation's history. It took us that time to get to $1 trillion, the first trillion of national debt. How long did it take us to get to the second trillion, to go from 1 trillion to 2 trillion? 60 seconds, what are you talking about? Close, it only took us 4 years. It took us, let's see, that was 1 trillion to 2. It took us 3 years to go from 4 trillion to 5. Took us 2 years to go from 8 trillion to 9. Took us 1 year to go from 14 to 15. Took us 9 months to go from 22 trillion to 23 trillion. Took us 6 months to go from 26 trillion to 27 trillion. Took us 3 months to go from 29 to 30 trillion. When Joe Biden signed the Fiscal Responsibility Act at the very beginning of June of 2023, it only took us 22 days to add $1 trillion to the debt. Most of us have had a mortgage before. Most of us have, had a car loan. We all know debt has some kind of interest rate on it. So what's the interest rate expense on our $33 trillion of national debt? Strap in. If I took the national debt, the interest rate expense on that debt currently, I annualize it, I adjust it seasonally, and this is coming from the Fed, as of Q2 of 2023, I don't have the Q3 numbers, it's about $970 billion. We were, I would say, $980 billion in debt back in 1981, and this is more than what we spend on our military. So, what does this mean? Better question is, what are we doing? Earlier this year, we saw the consumer price index, the inflation numbers start to come down. We started shifting out of inflation bonds, or U.S. inflation bonds. We then started going into intermediate bonds. Now, when interest rates are going up, you want to be short term. When interest rates are flat or going down, you want to go a little bit more longer term. We're not buying 20 year, we're not buying 30 years. We're trying to keep the duration and the time frame in these intermediate term bonds about 8 to 10 years. These are things including high quality corporate bonds, some international bonds just as a diversifier from the US, and then of course US Treasuries. So it started with the inflation bonds. Then we got to a point where the Fed basically, from our perspective, was done raising interest rates. They have caused enough damage, things were breaking, they had to be on the defensive, so we started moving from short-term bonds going into intermediate-term bonds. Now, one last thing before I hand it off to Jamie. I'm warning you. I am warning you. Enjoy your 5.25% money market and CD while you still can. Enjoy it. If this is like your emergency fund, if this is like money you don't know what you're going to do within the next 5 years, great. Yeah, just leave it in the money market, leave it in the CD. The reason why I am giving you this warning is because most analysts are saying that the Fed is going to start cutting interest rates about summer of next year. I think it's going to be a lot sooner. Americans are $1 trillion in credit card debt. The median income earner, the guy that is right in the middle between the highest income and the lowest income, the guy in the middle is spending 40% of their take-home pay on a mortgage right now. The banks are breaking. Corporate real estate in the 10 largest business districts in America, those, the corporate offices, those prices are coming down pretty hard. Okay? Now, 2/3 of our national debt, 2/3 of $33 trillion is going to come due within the next 5 years. 45% of the national debt is going to come due within the next year and a half, which means the government is going to take all these bonds that they were paying really cheap interest rates on. Now they have to refinance that debt at higher levels. It is becoming more expensive for the government to operate on itself. The reason why that is important is because 2/3 of our national debt is used to pay for two things: Social Security and Medicare. Now, I do not know, regardless of what your political affiliation is, I do not know one member of Congress who is stupid enough to go on the campaign trail next year and say, hi, Social Security Trust Fund is expected to run out of money by 2034, but don't worry, we're going to raise taxes on you and cut your benefits. Vote for me. Third rail of American politics, people. You touch it, you touch Social Security, you touch Medicare, you die. They are going to have to start lowering the rates. The question is, are they going to do it like steadily, or are they going to do it suddenly? Grocery bills are still very high. Gasoline is still high. There's a lot of chaos going in the world that I'm not going to steal too much from Jamie. But I'm just letting you guys know, I would not get comfortable. And even Jim told you from the very beginning, this is not a long-term solution. Enjoy it while you still can. Give it up for Jamie.
All right. It's a little heavy in here, isn't it? So stretch a little bit. Y'all had a carby lunch. We heard about a lot of things that are important that are going on, but things that are also kind of heavy, right? So lighten up. It's going to be okay. I'll tell you why. But before I get into that, I'm Jamie, if I haven't met you. I'm our office's certified financial planner. Nathan's getting his. What does that mean, though? So it means that I take all of the stuff Daniel talked about, what's happening with inflation, the government, spending, all those, and digest it down into what does that mean for you? What does it mean for your investments? How long will they last? I'm here to take what's happening in the world and make it relevant for you and your situations. Another thing that I also got this year was the Federal Retirement Consultant designation. We just realized we had a lot of clients, a lot of people around that worked for the federal government, but needed a good fiduciary to help them figure out what to do with their TSP, what pension benefits to take, what health insurance, etc. So if you or somebody needs help with your federal retirement plans, let me know, and I'm here to help out with that. All right, we're taking a little backtrack to the beginning of the seminar. You guys have the special, I guess, blessing of seeing me 30 years ago. So I can say I love what I do. I love helping people out with their finances, and I've been doing it since I was 4 years old. And I'm going to do it for the next 30 years, if not longer. So we have a nice little then and now. Maybe in 30 more years, we'll have one with me and one of my sons. Who knows? But just wanted to kind of put a fun little before and after there for you. All right, so what am I talking about now? Daniel talked about what has happened this year, what's going on, and I'm going to talk through what do we have to come and kind of boiling it down to what does that mean for you. But one more thing about what's happening economically. I feel like every time I come here, I keep talking about recession. I feel like a broken record. The last 2 years, there's been people saying, is there a recession coming? And there's all these whisperings, is there a recession coming? Yes, no, maybe so. We have some different people saying, what percentage do you think is a recession coming? So we have the Federal Reserve right down here in the bottom. Let's see, right down here. The Federal Reserve is very bold. They said 0% chance of a recession. I think they stand alone in that. We have the yield curve. So that's, it's been showing indications of recession for a while. What that means is short-term bonds are paying higher than long-term. It's starting to normalize, though. We're starting to get where the longer-term are paying more, as Daniel talked about. That's why we're shifting into intermediate-term bonds to help you get a higher return with stability. Economists are pretty split. That sounds pretty normal too. Economists usually say one way or the other, and they're always 50-50-ish. So they said maybe a 50% chance of recession. Consumers think it's more likely, probably because they're feeling the pressures at the grocery store. They're feeling inflation and things going up. Goldman Sachs thinks 15. Bank of America is about 40-ish, and CEOs think it's higher. So after this, we range from 0 to 84. It's kind of mucky, right? So the answer is maybe a recession. I know. Exactly what y'all want to hear, maybe. But let's talk about recession and stock market. The stock market is not the economy. They have parallels, there's correlations, but they're not the same. The economy can impact the stock market and vice versa, but they're not the same. So as you can see, the stock market right here, it's this orange one, it precedes economic events. So as you can see, they're both cyclical, right? They go up, they go down. We know that. They trend upward long term, but they go up and they go down. The stock market precedes it about 6 months. Why is the stock market going ahead of wherever we're at in the economy? Because we have all these investors out there saying, gosh, where are we going to be at in 6 months? And let me put my money where that's going to be to either protect it or to earn more. So you'll typically always see the stock market go in advance of the economy. So last year, 2022, pretty down. That's because they were looking ahead and they said, oh gosh, there's maybe some economic hard times coming. That's what Daniel was talking about. So that's partially why last year we had some market downturns. But the stock market recovers before the economy. So that's why we're shifting towards intermediate-term bonds, heading that direction to prepare for the recovery. We don't want to wait until it's recovering because then, gosh, you missed the boat. Too bad, so sad, your money didn't grow beforehand. So that's why we here are helping prepare for that. To come. So just remember, you hear recession, might not be the greatest thing for people that are lower income, that are more impacted by a grocery store, but it doesn't mean it has to be a bad thing. There's always opportunity within everything. There's opportunity in the bond world. There's opportunity for for buying certain kind of recession-proof investments, things like grocery store things that people buy no matter what. So there's always opportunity. That's what we're here doing, looking for you. All right, talking more through kind of next year and a little bit of this year. So next year, it's everyone's favorite season, election season. Who wants to have a sign in their yard and hear campaign smashing ads on the radio and the TV and everything? That's coming next year, but let's look historically, back at the last 200 years or so. What does the presidential cycle and the stock market, how do they correlate? Well, this year right here, pre-election year, looks pretty good. That's actually going in line with where we're at in the stock market-wise. It's been a pretty good year. Why does it do so good? A lot of the reason that the third year of a presidential term does so well is the stock market knows what's coming. They know what to it knows what's coming. They know what to expect, right? They've had this president in office for 2 years. They know pretty much what they're going to do. They kind of know the policies. They know where the House and Senate sit, sort of. There's a lot of knowns, right? So typically, we see a positive trend. And then the next year, kind of so-so. But talking about next year, when we're coming down to who's going to get in, red or blue, whatever you personally believe, the stock market doesn't really care. This shows quite a history of red and blue presidents that have been in office, and over the long term, it still trends upward. You know, sometimes there's a few flat years depending on what's happening in the world, but the stock market doesn't care who gets in. I know we all have our own thoughts, but just keep this in mind when you're heading into next year. When it comes to your investments, they don't tend to care which president's in office. It still has this trend line. One thing next year, though, we can tell you, volatility is a for sure thing. And that's always a for sure thing. Right here, not normal. I'd love for things to always go this way. Wouldn't it be nice to see it always just straight out going that way? It's just not normal. If that starts happening, call us, because we're not going to be okay. We're going to be freaking out if it's always trending that way. Normal is the ups and the downs. We see that happening throughout everything. Yes, we know the larger trends, but in the short term, day to day, you're going to see this up and down, but it's still going to be heading this way. So when you check your accounts every day, none of you do that, right? But if you check it every day, there are days that are down and there's days that are up. So if you do, just know, don't look at that daily fluctuation. Keep in mind the long term. So speaking of long-term and volatility, we have a really cool graph that talks about if you had invested 30 years ago and what happens if you panic and sell out when the tech bubble bursts at different moments and then your money's sitting in cash. Not a money market that's earning 5.25%, just cash. And then we have more. This one right here, can you guess? Great Recession, 2008. And so as you can see, there's different selling out points, right? Panic and sell out, but then it comes and recovers and supersedes it, and it continues, so on and so forth, throughout all these different events. So what I have to say to you here is, it can feel dismal in the moment. It can feel bad when you see things go down a little bit, or a lot of it. Just know in the long term, it's gonna trend this way. And we have your accounts in lots of different investments that can help protect against this. So anyway, look long term, if you sell out at any of these moments, look how the market highs keep overturning it every single time. All right, so that last one, you see the market turns, you see the fluctuations, you see the market events, and say you did sell out, you're like, oh, I'll sell out, I'll skip that and I'll get back in. Sounds awesome, right? Sounds awesome to say I'm gonna skip all the downturn and get all the upturn, or upward projections, whatever. But if you sell out, when do you get back in? Right? This graph right here shows if you started off with $10,000 and you just let it go, it's up pretty significantly. If you sell out and you don't get back in and you happen to miss just 10 of the biggest days, your returns are cut in half, and so on and so forth. I'm not saying that something would ever happen to cause us to say let's sell out, but through normal things that we can kind of see what's happening in the economy, in the long term, it's best to stay with that trend line and not try to say, oh, here's when to get in, here's when to get out, hopping in and out. If you hop in and out, you're going to find yourself with less returns. So when in doubt, call ElderAdo. If you're stressing out, we're here to talk you through it. And if you feel it's different this time, let's talk through it. Maybe there's some merit to it. But we're here to help give you guidance, give you advice, take the emotion out of it. So this is one of Daniel's and my favorite sayings: when in doubt, zoom out. So right, you can see here days. That's the fluctuation I've talked about. Decades, this is how it trends. Look, notice how much smoother it is on a decade basis. You're not seeing those day-to-day kind of heartbeat motions, if you will. See the positive trend line. And let me show you a really interesting graph, maybe. Oh, you decide. What do you want to focus on? Me personally, I'm going to focus on this longer term. And it doesn't have to be decades, right? It could be spread it out to months. The longer you spread it out, the more smooth it gets. So this is a prime example of when in doubt, zoom out, right? This is 100 years worth of time. And in the 100 years worth of time, I figured it was pretty relevant. We're talking about wars and conflicts and what happens in the world, and how does that correlate to the stock market. So we have the Russia-Ukraine conflict that happened last year. We have Israel happening right now. It's all horrible. But when you bring it back to what does that mean for your investments, you can see so many different world conflicts. But when you zoom out, right, if you were really close, you'd see it gyrating all up and down and all over the place. But if you zoom out, you can see it still has this trend line. You can still see some bumps, of course. You can still see the 08, but look at how it continues just to progress this way. So it can be easy to get bogged down in what's happening in the news and everything like that. But if you can take a step back and say, let's zoom out a little bit, you're going to find yourself successful. So, bringing it down a little bit, bringing it more close to home on what we as advisors do for our clients every day. We truly are an advisor. We're here to help give you expertise, advice, and whatever you're going through. So a lot of times we find ourselves in between our clients or you and a potential big mistake. One mistake that I just showed could be selling out when things are at the low. We have a few other stories. There was a client that got a letter that said, oh my gosh, I won the lotto. I just need to send all this information to this person. I'm going to get it. And they brought it to us and said, what do you think? And we said, scam, stop. So we helped prevent them from losing their identity. We have another client that said, I want to put half my money in this one random company over here. We said, let's evaluate it. Turns out it wasn't a good investment, so we said, let's not do it. We saved them from losing a significant amount. It was a local company that they wanted to put some money into. Found out a few years later, the company went bankrupt, and any investor lost all of their money. Likewise, there are success stories. If we hear of something that looks like a good investment, we'll tell you. Another mistake that could be is taxes. Are you paying too much in taxes? A few years ago, we saved a client $100,000 in taxes with a recommendation for them. It was to convert assets to a Roth IRA. It's not always right for everyone. It was situational. But we saved them $100,000 in taxes. That's a pretty significant mistake that could have happened. One last story on this front. We have another client. One day he just decided he needed a horse trailer. Did he have a horse? No. But he needed a horse trailer, so he went and got a horse trailer. And then he took a step back and said, oh gosh, what have I done? Why did I buy a horse trailer? So he recognized something within himself, that as he was aging, he maybe wasn't making the best choices. So I found this interesting study that correlated with his experience. Now, it's not always the case. We've just had a lot of clients starting to recognize this, that as you age, sometimes things are harder to manage. Could be keeping up with the technology of where your investments are at. It could be managing multiple investment firms. There's also word recall. So as you age, like I said, not all the time, this is a study, it said that your financial literacy and word recall can decrease. Interestingly, along that fact, is confidence never wavers. So in our gentleman's situation that wanted to buy a horse trailer, he was confident he needed a horse trailer. We had his confidence up here. Was he making the best financial choice? No. So we're here to help bridge that gap. We're here to help if you need another set of eyes to say, hey, does this make sense? Or help protect, your accounts from doing something like that. We're here just to help. We help a lot of spouses, right? Where one spouse manages all the money and the other doesn't. We help bridge that gap. If something happens to the spouse that manages money, we want to be here to help that other one pick up the pieces if something to happen. So in line with that, we had a wonderful client who suggested this. We created a bill tracker, just something tangible that can help if one spouse manages the money and the bills. You can put all of the information in here or whatever you're comfortable with to keep yourself organized, but also make sure that the spouse that's still there that doesn't know the finances can pick up where you left off. It's also can be if you have a friend that's going to manage your money, or if you're not able to, for your financial power of attorneys. It's just a resources we wanted to get in our clients' hands, if you want, to help make things a little bit easier if something were to happen. We have some of those out on that front table as you walk in, so if you want one, grab one. If you want a soft copy, let me know. And if you have suggestions to make it better, tell me as well. So just one small thing to try to help organize and make things easier down the road. Leave you with one last thing. We talked about a lot of things today that matter, right? There's war, there's inflation, government spending, all sorts of things that they really matter, right? Your investments matter, your health matters. There's a lot of things in life too you can control, right? You can control what you eat on the health front. You can control how much you spend on your financial side. You can control your investment risk tolerance. There's a lot of things you can control. So my goal, my challenge to all of you, is find this sweet spot, right? What do you focus on? What matters, but what can you control? There's things that matter and you could get sucked into the news, right? It matters, but can you control it? No, you're just going to stress yourself out. That's what we do at ElderAdo. There's a lot of things that matter. We're watching all this stuff in the economy and the world, and some of it's unsettling. But we say, okay, what's happening in the world? That matters. What can we control? And we focus on that. And we say, let's position clients' accounts in this way to take advantage of this recession that's coming, or let's position the bonds to be ready for when the yield curve moves. We're doing all these things day in and day out. So my job for you, focus on what matters and what you can control. Here's our survey. If you guys have any questions, write them down. Any suggestions for Charles Schwab that Daniel and Nathan can take, write them down. And thanks for your time.